Currently, there's proposed legislation under consideration by lawmakers that might impact 175 million payment cards throughout the United States, potentially terminating them entirely, not temporarily freezing them, not lowering spending thresholds, but completely canceling them. Those who would see their accounts affected initially include society's most vulnerable individuals: retirees living on unchanging retirement benefits, individuals managing healthcare expenses, those with financial ratings under 740. This isn't discussing potential distant scenarios happening sometime later. America's chief executive has openly supported this proposal. This legislation has cross-party backing within both congressional chambers. Financial institutions have explicitly informed lawmakers through official testimony precisely their response should this become law. They'll terminate accounts, not hundreds, not thousands, 175 million total. Let me explain precisely the situation unfolding. The reasoning behind why mathematical calculations ensure widespread account terminations become certain. How termination impacts your financial rating, plus overall economic well-being. How another legislative proposal advancing through lawmakers simultaneously affects your cashback benefits, plus 5 exact actions necessary immediately for safeguarding yourself prior to implementation. Should you possess any payment card currently, these upcoming 20 minutes might prevent an unexpected monetary crisis you haven't anticipated. Allow me to begin with the actual developments, since many individuals have merely encountered surface-level reporting. These reports appear positive initially. During January 10, 2026, America's leader urged lawmakers to establish payment card borrowing costs at 10% temporarily. This was positioned as assistance for diligent citizens struggling with payment card obligations. Initially, this appears like excellent monetary developments you've encountered recently. Consider this reasoning. America's typical payment card borrowing cost currently reaches 28.7%. Certain accounts exceed 30%. Should you're retired maintaining an $8,000 obligation, approximately matching nationwide statistics for individuals above 60, you're contributing around $2,200 annually solely toward borrowing costs. That equals $183 monthly. This doesn't decrease your obligation whatsoever. Banks receive everything. A 10% maximum would decrease yearly borrowing expenses to $800. You'd retain $1,400 additionally. Therefore, what makes me suggest this presents risks? Since seemingly beneficial changes for consumers mean account termination becomes certain. Consider this aspect: television coverage isn't clarifying. Payment card providers aren't nonprofits. They aren't public utilities. They're commercial enterprises operating for profitability. Their revenue generation occurs through 2 main channels. Initially, through borrowing costs on outstanding amounts individuals maintain monthly. Approximately 60% among American cardholders maintain outstanding amounts. Among retirees above 62, that percentage reaches 43%. Additionally, via processing charges, sometimes termed transaction charges, collected from retailers whenever customers make purchases. Through these dual income channels, payment card providers earn massive annual revenues. Borrowing cost revenue represents their primary income, particularly enabling lenders to balance potential lending defaults. Consider their lending evaluation process, which explains subsequent developments. During application processing, lenders review your financial rating, then determine lending categories. Should your rating exceed 780, you're classified as premium customers. Lenders understand through extensive historical information that customers within your classification typically default around 2 to 3%. That's minimal. Lenders might apply 15 or 18% borrowing costs while maintaining reasonable returns, since your classification rarely defaults. However, should your financial rating reach 620, you're classified differently completely. Individuals within those ranges typically default between 8 to 15% based on market circumstances. Lenders must apply 25 or 30% borrowing costs for covering anticipated defaults while remaining profitable. This isn't exploitation. This represents mathematical requirements for categorized lending. Consider how borrowing limitations affect these calculations. Should borrowing costs become limited at 10% while anticipated defaults reach 12%, lenders experience losses for each amount provided to customers. Certainly, absolutely. Lenders cannot apply sufficient borrowing costs for covering anticipated defaults. Therefore, lenders have one logical option. Account termination occurs. Nothing personal exists. Nothing partisan exists. Basic calculations any student could perform quickly. The Digital Transaction Alliance, including Visa, MasterCard, JP Morgan, Chase, Bank of America, plus essentially all significant lending organizations nationwide, released comprehensive research during February 2026. Their findings stated directly, a 10% borrowing limitation would cause account terminations or spending reductions for approximately 90% among existing cardholders. 90%. That represents nearly 175 million citizens. The Financial Services Organization published separate research reaching comparable conclusions. They determined between 74 and 85% among active payment card relationships across America would experience termination or significant spending reductions. They calculated between 137 million and 159 million customers would forfeit existing lending availability. Using either higher or lower calculations, we're discussing history's most extensive mandatory consumer lending elimination. Understanding who experiences immediate impact becomes crucial since effects aren't universal. Should your financial rating exceed 740, you're probably protected. Lenders remain profitable providing lending at 10% since your default probability allows sustainable calculations. Your spending threshold might decrease, and benefits will probably disappear, though your relationship should continue. Should your financial rating fall between 670 and 740, your relationship faces significant danger. Lenders will calculate your particular lending category, then determine whether maintaining your relationship remains sustainable. Numerous relationships within this bracket will terminate. Others continue with significantly decreased thresholds. Results vary between lenders and individual backgrounds. Should your financial rating fall under 670, directness becomes necessary. Your relationship will probably terminate. Calculations become unsustainable at 10% borrowing costs for customers within these lending brackets. No scenario exists where lenders accept losses maintaining your relationship. Consider individuals within these brackets. Retirees receiving unchanging retirement benefits, maintaining modest obligations for covering medications or essential services during retirement payment intervals. Typical citizens above 65 maintain roughly $5,000 in payment card obligations. Often, these obligations don't result from excessive purchases. They result from selecting between medication refills versus electricity payments, then utilizing payment cards covering whichever remained unaffordable monthly. Individuals experiencing health crises placing medical expenses on payment cards lacking alternative options. Typical 3-day medical stays throughout the United States exceed $30,000. Despite coverage, personal portions become overwhelming. Young individuals beginning financial establishment having minimal records and developing ratings. Not through irresponsibility, simply lacking sufficient duration establishing backgrounds. Service members handling money during assignments where timing issues and practical difficulties occasionally cause delayed transactions, damaging financial ratings. These aren't careless individuals. They're utilizing lending precisely following established systems. However, understanding chain reactions becomes essential since losing access represents initial consequences only. Following payment card termination, whether customer-initiated or lender-initiated, your combined lending availability decreases instantly, though current obligations across remaining accounts remain unchanged. This modifies something termed your lending usage percentage. This represents among your most critical financial measurements. Lending usage comprises approximately 30% within your financial rating through standard evaluation systems. Calculation involves comparing combined payment card obligations against combined lending thresholds. Consider this practical scenario. Imagine maintaining 3 payment cards. First card provides $10,000 availability with $3,000 obligation. Second card provides $12,000 availability with $4,000 obligation. Third card provides $8,000 availability with $2,000 obligation. Combined availability equals $30,000. Combined obligation equals $9,000. Usage equals 30%. This matches suggested limits. Subsequently, third card becomes terminated through lending limitations. Availability decreases to 22,000. Obligation remains at 9,000. Usage increases to 41%. This 11 percentage growth in usage might decrease your financial rating 30 to 50 points nearly instantly. Here's what's particularly difficult. Following financial rating decreases, borrowing costs on surviving accounts might increase. Vehicle coverage costs might rise since numerous providers incorporate financial ratings within calculations. Housing rental becomes affected since property managers evaluate finances. Mortgage adjustment opportunities, potentially reducing hundreds monthly, become challenging or unavailable. Single termination creates cascading consequences, affecting unexpected financial areas. Regarding retirees particularly, another consequence layer exists rarely discussed. Numerous retirees utilize payment cards representing their main contingency resources. They lack $10,000 within banking reserves. They maintain payment cards providing $10,000 availability usable during heating failures, or vehicle maintenance, or unexpected healthcare expenses. Removing access eliminates beyond transaction methods, eliminating complete monetary protection. Options include short-term lenders applying 300 to 400% yearly borrowing costs, vehicle-secured lending risking transportation, or avoiding necessary healthcare or property maintenance. This represents actual individual consequences from these measures apparently unconsidered within policymaking. Additionally, another legislative proposal exists worsening previously described situations. The payment card marketplace legislation was resubmitted during January 2026, receiving cross-party endorsement from legislators Durbin and Marshall, alongside related proposals within Representatives Loughran and Gooden. America's leader supported this also. Online statements describe transaction charges representing uncontrolled exploitation. Actually, he's correct regarding charges. Typical households contribute almost $1,200 annually through transaction charges incorporated within all purchase costs. Whenever purchasing food, fuel, apparel, restaurant meals, retailers contribute between 1.5 and 3.5% toward transactions. Retailers don't absorb expenses, they incorporate them within costs. Therefore, you're contributing transaction charges, regardless using payment cards, banking cards, or currency. $200 annually from all households nationwide. Financial organizations receive above $111 billion annually through these charges. The marketplace legislation would require institutions exceeding 100 billion holdings, enabling their payment cards processing through minimum 2 alternative transaction systems beyond only Visa or MasterCard. This concept seems straightforward. Marketplace forces reduce charges. Retailers select economical systems. Charges decrease, costs decrease. All benefit. That's theoretical reasoning appearing financially logical theoretically. However, institutions have clarified their planned reactions. They'll eliminate benefits, cashback, vacation credits, travel rewards, consumer safeguards, coverage extensions. These benefits receive support mainly via processing charges institutions receive per transaction. Should charges decrease via required marketplace forces, income-supporting benefits vanishes and institutions won't substitute income from internal revenues. They'll remove benefits. Among retirees, cashback benefits aren't extras. They're substantial monthly resources. 2% returning from food, 3% from fuel, 1% from general purchases. Annually, this accumulates toward $300, $400, $500 representing actual resources. Removing this essentially reduces retiree income beyond other impacts. Imagine both legislative proposals succeeding within concurrent sessions, entirely feasible considering both receive executive endorsement and cross-party agreement. Borrowing limitations terminate relationships for ratings under 740. Marketplace legislation removes benefits despite relationships continuing. You'll either forfeit access completely or maintain access lacking usage advantages. Within both situations, individuals least capable absorbing consequences, those receiving unchanging benefits, those having minimal reserves, those experiencing monetary pressure receive maximum consequences. Allow complete transparency regarding my stance. These legislative proposals aren't automatically poor governance. Limiting exploitative borrowing costs, creating obligation cycles, represents valid significant governance objectives. Establishing marketplace forces within transaction systems, controlled by dual organizations, remains financially reasonable. These represent actual issues requiring actual responses. However, current legislative structures mean impacts affect mainly intended beneficiaries. That's beyond perspective. That's industry information demonstrates. Delaying until enactment before establishing safeguards represents unaffordable errors. Therefore, 5 exact actions required immediately despite legislative outcomes. First action, evaluate your financial rating immediately, not later. Immediately. Access this freely through annualcreditreport.com, representing sole government-sanctioned resource providing complimentary financial evaluations. Additionally, check via financial institutions' digital platform or portal. Major institutions currently display FICO ratings complimentary. Your evaluation targets simplicity. Above 740 provides protection, though preparation remains important. Between 670 and 740 places you within danger requiring prompt response. Under 670, expect relationship impacts and begin establishing substitute lending immediately. Second action, reduce payment card obligations using maximum possible efforts. Each reduction decreases usage percentages, safeguarding financial ratings and reducing termination probability. Consider this crucial approach. Avoid prioritizing accounts having maximum total obligations. Prioritize accounts having maximum usage ratios. Accounts reaching 80% usage create greater financial rating harm versus accounts reaching 30% usage. Despite 30% accounts having higher amounts, reduce maximum usage accounts under 30% initially, subsequently pursuing everything under 10%. Individuals maintaining usage under 10% average financial ratings exceeding 800. Third action, avoid voluntarily terminating payment card relationships. Specificity becomes important since numerous consultants suggest terminating dormant accounts. During typical circumstances, this occasionally seems logical. Currently, it's extremely inadvisable. All active payment card relationships, including dormant ones, add toward combined lending availability. This availability maintains minimal usage percentages. Voluntarily terminating accounts having $10,000 availability eliminates $10,000 from lending availability, increasing usage. Rather than terminating dormant accounts, utilize all quarterly for minimal transactions, then immediately satisfy. This maintains activity, avoiding institutional termination through dormancy, maintaining lending availability. Fourth action, create contingency resources independent from payment cards. This seems challenging, particularly receiving unchanging benefits, though minimal contributions matter. Begin contributing $25 monthly toward distinct enhanced return reserves. Digital institutions including Marcus, Ally, and Discover presently provide between 4 and 4.5% yearly returns through reserve holdings. This won't create abundance, though establishes modest protection personally controlled beyond institutional determinations. Through 6 months, that's $150. Through 12 months, $300. This potentially addresses vehicle maintenance or surprise healthcare portions, avoiding payment cards potentially unavailable. Fifth action, create membership through cooperative institutions immediately before necessity. Cooperative institutions differ essentially from institutions. They're participant-controlled, not investor-controlled. They're not exchange-listed. They avoid similar periodic revenue demands, causing institutions terminating relationships during initial uncertainty. Numerous cooperative institutions provide payment cards, having borrowing costs currently significantly under nationwide statistics. They provide adaptable lending standards. They frequently maintain reduced charges and superior assistance. Should relationships through Chase or Bank of America terminate, maintaining current cooperative institution membership provides alternatives. However, cooperative institutions require participation standards and enrollment procedures. Avoid delaying until desperation. Establish fundamental reserves through nearby cooperative institutions, currently creating participation and establishing foundations for subsequent development. Additionally, one critical caution required: monitor fraudulent activities. This appears within all communications given significance. Whenever significant monetary governance modifications or developments impacting countless individuals occur, fraudsters activate immediately. You'll encounter messages appearing from payment card providers, indicating relationship termination approaching, requiring verification through links. That's deception attempting credential theft. You'll receive communications from individuals representing Visa or MasterCard, requesting account verification and validity confirmation. That's identification fraud. You'll observe promotions through Facebook and Instagram from organizations guaranteeing financial rating security or relationship preservation, requiring initial payments of $200 or $500. These represent deceptions. Legitimate payment card providers communicate via established methods, via applications, via digital relationships, via postal correspondence. They won't telephone requiring prompt responses. They won't message including links. They won't manufacture false deadlines. Primary indication representing fraudster communication involves anxiety creation. Should communications create immediate response pressure? Pause, disconnect, remove communications. Reach institutions personally via numbers appearing on account backs. Here's the summary. Dual legislative measures having extensive governmental backing advance via lawmakers concurrently. One establishes borrowing costs mathematically preventing institutions sustaining majority payment card relationships. Another reduces income supporting all benefits programs utilized. Neither succeeded currently. However, both receiving executive support and cross-party agreement indicates probable trajectory. Preparation timing isn't following enactment. It's immediately. Evaluate financial ratings immediately. Begin reducing maximum usage accounts. Maintain all relationships active. Establish reserves beyond lending. Create cooperative institution participation. These aren't extreme actions. They're practical monetary actions providing security despite legislative decisions. Should legislation succeed, you're prepared. Should legislation fail, you've achieved enhanced monetary stability regardless. Absolutely zero disadvantages exist through preparation. Should this prove valuable, distribute toward individuals maintaining payment card obligations. That represents above 50% nationwide currently. Combined payment card obligations nationwide reached $1.28 trillion. That's maximum documentation achieved. Individuals maintaining obligations face maximum vulnerability from approaching changes. Follow since these developments persist during 2026 and all potentially impact your finances. Submit inquiries within responses. Your inquiry potentially creates upcoming content.